Welcome to Raise Your Game, the podcast where we break down the smartest, simplest, and most effective ways to take control of your financial future. Whether you're looking to save, invest, budget, or find new ways to boost your income, we're here to give you the tips, tricks, and strategies you need to make your money work harder for you. Malone, MD and CEO from Raiz is your host, and each month we'll dive into expert interviews and the latest financial trends to help you build wealth and achieve your financial goals. So grab your earbuds and get ready to level up your financial game.
Hello all, welcome to our brand new Raiz podcast. Today we're here with Mr. Ben Nash from Pivot Wealth. Morning, Ben.
G'day.
Look, today's going to be a fun session. What we're trying to do is make these podcasts real down to earth, real friendly, and just a conversation. And you and I have known each other for quite a long time. We have some good laughs and good giggles and some entertaining emails between the two of us. But what I thought we'd talk about today was the Millionaire's Marathon. You know, it's not a sprint. Investing and savings over your life is something that we must do over a period of time. It just doesn't happen. There is no such thing as the quick buck. What's your investing history been in life? How did you get to where you got to today with Pivot Wealth?
I've made the mistakes, the common mistakes that people make when they get started. It's like you're expecting these really big results in a really short amount of time, and investing just doesn't work like that, or at least not sustainable investing. And I think commonly, like, everyone sees those stories online that, you know, all these people made a bunch of money in a short amount of time. And you sort of want that, the inner investor. I sort of nerd out on the money psychology side of things, that people are wanting these big returns, but don't realize that you just can't really do that. There's the odd people that will get lucky and do it consistently for a short period of time, but it's unsustainable. And instead of doing that, and if you just start small and be consistent, then you are going to get there. Regular investing, compound interest, using the power of the share market returns. It's not a matter of if you'll become a millionaire, it's just a matter of when, and it's a function of when you get started and how consistent you are.
I think that's great. And that's something we try to do with Raiz, is small amounts over time consistently. And you sort of mentioned a term, compound interest. Can you break compound interest down for our listeners?
Basically, when you invest into shares or any investments really, that it generates a return on those investments, and then the money continues to grow, because then you've got more money that's invested. And so if you say you invest $100 today, and then in a year's time it's worth $110, you now have $110 that's growing. So the next year it's going to be $121, then it's going to be $135, then it's going to be $150, and basically compounds from there. I think the compound interest term is a term that a lot of people get quite confused about, that they're like, how do I get it? I want it. How do I turn it on? I've literally had that question from some people before. Do I need to do anything? And it is confusing, because there's a lot of noise out there when it comes to the world of investing, I think, but it's just investing into anything that delivers you a return that you can then reinvest to compound your results over time. Get started now and start as soon as possible. I just put an example here to say that if you want to build $1 million in investments, if you're 20 years old today, you need to save and invest $5.50 a day. If you wait until you're 30, it's $15 a day. At 40, it's $44 a day. And if you wait until you're 50, it's $161 a day. So $5.50, most people could find that. That's like a coffee and a half, depending on maybe one coffee if you like the hazelnut latte sort of flavor or whatever. But $15 is probably okay. $44 a day, that's getting pretty tricky. And $161 a day, most people don't earn that, let alone have the ability to save that. So the sooner you start, the less you need to do to end up in the same position. And then you just let that compounding do its thing.
Small amounts over time add up. So when we talk about that, people, have you got any examples of any great long-term investing that you've either read about or you've spoken to people about?
When you invest, there's really two main ways that you can do it. One is that you invest into passive investments, and they're called passive or index fund investments that passively track the share market overall. And so if you think of the Australian share market, that an Australian share index fund or an Australian share index ETF or an Australian share micro index option will invest a small amount into literally every single company that's listed on the stock exchange. So when you invest in that way, the return that you get on your investments is going to be the same as the return on the total share market. The alternative is that you use an active investment approach, where you've got generally a fund manager, or perhaps you're even doing this yourself, where you're picking specific companies that you think are going to perform better. That has potentially a bit more upside returns if you can do it. But the thing is that the statistics show that index fund investments do better than active investments more than 80% of the time. And so particularly for people that are thinking about getting started investing, index funds, and this is not financial advice, and you should seek that out from your, licensed financial professional, but it can be a definitely worth you looking at as a way to get started, particularly if you don't have a lot of investing knowledge, because you're literally just getting the whole share market. And the other great thing that I like about index fund investing for our clients, and we do this a lot, it gives them a lot of peace of mind, because the only way that an index fund investment can go to zero is if literally every single company in the country goes bust at the same time. And so if you think about that in the Australian context, we've got all of the banks go out of business, the mining companies, Telstra, the supermarkets. It's like, if that happens, you've got much bigger problems. You've got much bigger problems than your investment portfolio. This is like a zombie apocalypse type situation.
Exactly. And I think too, the way you've mentioned it and going into index, there's another key term that people throw around, and that's diversification. And correct me if I'm wrong, but this is what the index gives us.
That's right. So diversification just means spreading out your risk. So if you've got $10,000 and you invest it into one company, then your returns are going, when that company does well, you'll do well. When it does less well, then you do less well, essentially. If you got $10,000 and put it into two companies, you're immediately more diversified, because the highs of one company will be balanced by the lows of another. And so your return will be smoother over time. With an index fund, because they're investing in literally hundreds of companies at the same time, you buy one investment option, you choose one investment option inside your app, and then you've got immediate diversification, and your risk is a lot more spread out. So what that does is it diversifies away, to use a bit of jargon, the company specific risk. And it means that you're left with the overall share market risk. But the share market risk, that's the risk that you want. That's the risk that will make you money.
And I think too, what I like about diversification and compounding, obviously, is that we're learning financial literacy and education. You're learning about these other companies that you may invest in, or other industries that they may. So you're understanding some financial literacy there and financial education there.
That's right. And you can't pick the industries that are going to do well. I think if the last few years have taught us anything, it's like when COVID happened, technology went ballistic for a while. Then technology came off, resources came up, and the resource companies were doing well. Tech was doing not so well. Then we're seeing more AI and clean energy type companies and these sorts of things. And so when you're nice and diversified, it means that you're always going to have a bit of the best performing results. And that's why you get consistent outcomes over time.
Yeah, there's a lot of conversation in the market, in the media today, about the wealth transfer. But whilst the wealth transfer is important, I think it's really important that we actually start with our kids as well, so they understand money, they can understand financial literacy, financial inclusion, and financial awareness. So let's have a quick just a chat regarding sort of securing your children's financial future.
Yeah, look, I think I'm a parent myself, and work with a lot of families as well, and I think that people increasingly recognize the importance of investing for themselves. But at the same time, if you've got a family, or you've got kids, or you're thinking about having kids, a lot of people are quite mindful of the fact that things don't seem to be getting any easier. If you look at some of the statistics, quite scary in terms of the decline in property affordability over time. The double-edged sword of our massive uptick in our living standards is that it is quite expensive to live well in Australia. I think we're really fortunate to live in a great country here, but living well in Australia does not come cheap. Where we are in Sydney, we've got the most expensive property market in the country. Median house price $1.3 million. Average income across the country is circa $100,000. It's like, if you want your kids to be able to have a secure future, a lot of people are thinking about, well, what can I be doing to firstly set up my own investment, so I'll make sure that I'm sorted, but then, can I be doing a little bit, or should I be doing a little bit to create some investments for the kids as well?
Absolutely. And, at Raiz, we have a product called Raiz Kids, and it's great to see we've got over 44,000 people starting to think about that and have opened up Raiz Kids accounts. And what I believe in, and what we try to do at Raiz, is provide this hands-on experience. It's getting them in front of financial literacy, financial terms. If we can get those kids to start understanding that now, I think it'll fill a massive generational gap coming up. And when we listen to what our customers at Raiz are saying, we know that it's not the bank of mum and dad anymore. It's the bank of mum and dad and grandparents. And to your point, the cost of living and helping it out. So what sort of ways can people look to sort out this sort of financial future, not only just in a bank account or dollar value, but the financial education and literacy?
I think a lot of parents in particular, it's pretty common for people to start be putting a little bit of money aside for their kids. But I'd say that the most common way that people do that is actually just in a straight savings account in the bank. And that's great. And obviously it's better to have money in a bank account than not have any money in any bank account. But the reality is that with inflation where it is, and then the fact that interest income on bank accounts is taxable, that any money that's sitting in a bank account is effectively going backwards in real terms. And so that means that if you're trying to find some extra money and push yourself to save so that you've got some money for your kids, it's probably not going to be it's definitely not going to be worth the same in 10 years time, 20 years time than it is right now. And so I'm sure they're going to be really appreciative. Don't get me wrong. I'm sure you cut a check for your kids on their 18th or 21st or 30th. But if you're investing for the long term, you are sort of missing a trick if you're not investing the money into growth type investments. Now, I think if you're going down this path, it is really important that you're aware that anytime you do invest through an app like Raiz or any share type investments that are in the share market, that you will have market ups and downs. And the suggested investment time frame for those sorts of investments is 7 to 10 years or more. So it's probably not the most sensible thing to be doing to invest money that you're going to need next month or 6 months from now, just in case there are a decline in the share market during that time. But if you're investing for that for a decade or more, or 18 or 21 years, like I said, you are probably missing a trick if you're not using the power of compound interest to be getting more of a return on that.
And I think it is too, again, whilst putting them into, maybe it's a Raiz account with equities or underlying equities in it, you can help educate the kids where it's not just a bank account, because they will have a bank account as they're growing up from a transactional point of view. So what is this myth over here that is the equity markets, that can give them hands-on experience straight away?
100%. I've got, my kids are 5 and 3. The 3-year-old's not particularly interested, but the 5-year-old is a little bit more. It's sort of starting to connect a few dots. And I love talking to her about this stuff. And not that I'm expecting her to take it all in, but talk about the portfolio. I might open it up, show her the squiggly line, talk a little bit about investments, talk about when we get money, when she gets a gift, like you said, the bank of mum and dad and grandma and the grandparents or family, talk about what are we going to do with it. We can enjoy some of it, but we're going to save some of it. We're going to invest some of it. Maybe we're going to give some of it to charity or something like that, to start to get them some exposure. Because I think the issues that we've got around financial literacy are real in this country. It's not getting any easier, and there's so much complexity that's out there as well. And so, I keep hearing about how they're going to be doing more of this in schools or potentially universities, but I think that starting at home and getting some exposure early on is something that's really important.
Absolutely. Look, you and I are a bit older. There may be some listeners, but we've heard about it for a long time, that it's coming to the school, but it's just not coming as quickly as what the world needs or what the everyday consumer needs. And my son's, I've got a 6 and 3-year-old, Tom's 6 and Izzy's 3. It's Izzy's birthday next week, and we asked her what she wanted for a birthday, and Tom piped up and said, "Money for my Raiz account, money for my bank account," because he's understanding, and he's only 6, but he's understanding now the value of money. And what I mean by that is, we go down to the beach. He wants an ice cream and Izzy doesn't. I said, well, if you do this, you're going to have $5 left and Izzy's going to have 10. And he can understand and go, well, is that ice cream really worth it? He's supposed to have made his bed or tidied his room for his pocket money, but he's understanding the value of money. And that's at the age of 6.
Yeah, I think that exposure is all important. And the fact that investing is something that you should be doing is another thing, because I think in previous generations that property has been huge in Australia. It's hugely effective, and it continues to be hugely effective. And so there's absolutely no taking away from that. But a lot of people haven't invested outside of their home or through their super fund. And so for those people, if they're investing for the first time when they're in their 30s or their 20s or their 40s, it's a lot scarier than having that exposure and starting to learn and realizing that this is what people do. And so it's a natural thing to do. It's about making sure you're doing it in the right way, not do you do it at all.
It is knowing what you're investing in, having an understanding. And what I mean by that is, I've been out to the university and I've spoken to groups of people. I'll say, put your hand up if you're in the stock market, and nobody puts their hand up. And then I say, hey, put your hand up if you've got a superannuation fund. And they all put their hand up. Now,
yeah.
It's highly likely under the Australian structure of superannuation that they've got some exposure to the Australian equity market.
That's right. And people don't realize what's
No.
in these accounts, and they don't realize that they've got control over what's in their super funds as well. I think if people had $10,000 or $20,000 or $50,000 sitting in a bank account or an investment account, they'd be paying a lot more attention than if they have the same amount of money in their super fund. And the stats are quite scary. 2/3 of Aussies, or maybe more than 2/3, that have a super fund that was just the default one that's offered by their employer. And I'm sure that employers, I'm an employer myself, I know that you are too, that you do, when you think about what is the default offering for your team, you're trying to think about what's going to work well for the team for sure. But it's hard to find a one size fits all approach for people as well. And so taking an active role in controlling this money that is your future superannuation nest egg, that's going to make a difference. And even just a 1% return over a number of years in investment performance makes a huge difference to your bottom line.
Over a 20, 30-year period, it makes an absolute difference to your retirement. Let's have a chat about habits. Everybody, as soon as we hear the word habits, we always think they're negative. And one thing I want to say here is the use of technology. It can help people with things. We use electronic calendars now to stay in touch. We use WhatsApp, but we can use automated functions on either savings or awareness of where you're spending your money through certain fintechs. And Raiz can do that for you. But let's talk about habits, Ben.
Yeah, look, I think that if you're younger in particular, that the habits that you have around your saving, investing, and your money broadly will have a much bigger impact than the actual investments that you choose. I think a lot of people fall into the trap of thinking that to be successful with your money, you need to choose great investments. And that's part of the picture, but it's being good at how you're investing, how consistently that's happening, how you're planning with your money decision making. All of these sorts of things will have a much, much bigger impact. Or to say it a different way, if you just choose good investments and all of those other things aren't working, you're always going to fall short of your results. And so James Clear has the incredible book, Atomic Habits, and he's got this incredible quote in there that has always stuck with me that says that you don't rise to the level of your goals, you fall to the level of your systems. And I think that that's so important. And he's a big one on set your habits, habit stacking. It's like, how do you make sure that if you've got a habit that you're doing it, that you're setting yourself up for success, that you've got the time allocated? Can you bundle some habits together so that you can knock them over at the same time? And then you get that compounding effect. And I think technology is a great supporter of some of your habits and behaviors around money. But ultimately, there's some things that you need to be doing. You need to be clear on your planning. First step. And it can be a simple plan. If your situation is simple, it could be a clear budget and a bit of an investment plan, or at the very least, knowing how much money you can or want to be investing every week or month or whatever the case may be. As things evolve and as your situation evolves when it comes to planning property purchases, having children, maternity leave, time out of the workforce, all of those sorts of things, that you need to be taking a more robust approach to your planning. But that's really where it all starts. Then a plan is good, but a plan without a system won't work. You want to have, your automatic investment planning happening. You want to have a clear structure for your banking. I think that's an absolute game changer when it comes to your habits, where you've got different bank accounts. It's how I run my own money. It's how we do it with our clients at Pivot Wealth as well. I've got a pocket money account. Every week, a few $100 goes in there. That's my spending money for the week. I know what that is. I've got a separate savings account that I can see going up. That makes me feel good. It makes me keep going, because saving money is like you're delaying pleasure today to have a bit more pleasure in the future. And so you've got to try and hack your thinking and make it a bit easier for you to actually do that. So having a system, making it work, and that gives you the framework to build your habits around.
Once you're in a habit, it keeps going. I mean, I think to your point, instant gratification has affected a lot of us. I get that instant gratification by seeing that savings account going up each week. I'm leaning on the technology to sort of set and forget it.
Well, I shared in my new book, Virgin Millionaire, which is out soon, subtle plug, I shared the story about my own planning. And I've always been a bit of a planner, but a few years back, I sort of let my planning slip a bit. It was shortly after we had our first kid, and then COVID was running wild, and it was like disrupting my business and my team and my life. It was like we sort of let things slip a little bit. Firstly, we stopped doing our monthly check-in that we were doing, where we just really simple, but like, what happened last month? What were the wins? What can we improve? Was there anywhere that we fell short? What do we focus on next, sort of thing? So that sort of slipped. Then we stopped doing the quarterly check-ins. Then we stopped doing the annual planning, and I didn't realize, but it was a bit of a slippery slope. slope in that quite quickly things weren't working as well as they had been in the past. And previously we were at this point where everything was almost sort of effortless. It was nice and easy. We were motivated. We were staying on track and we were getting some good results. And so we decided that things needed to change. And it actually took quite a lot of effort to get things back to where they were, that it started slow. We were a bit inconsistent. We were a bit patchy, but we eventually sort of got it back there. But it did actually take a lot of time. And the thing with habits is that they're hard to form, but they're really easy to break. And when you do create good habits, you want to sort of try and set them in stone as much as you can. The biggest thing that we did to get things back on track was our regular investing. And so it was only when we did that, we got a bit more motivated again. And then it's like we ticked it up a little bit, then we ticked it up a little bit more. And then, eventually we got it back way above where it was before we got to that point. But it all sort of started there. So you want to pick a starting point and look to build on that as much as you can.
That gratification you get for getting back to that amount, it's rewarding. Life changes, plans change, but it is knowing what's changed, knowing how to get you back on that path. And we did a survey a few years ago and 78% of Raiz customers have a budget. And then in the small print, it's 48% stick to it.
I think you've got to find what works for you, because ultimately everyone's different. Some people are going to be better at saving or better at investing or better at spending. Like at the end of the day, you've got to pick your strength, build around that, but also don't beat yourself up too much if you do fall short, because we all fall short. It's like you skip a gym session or something happens, like that's okay. The important thing is what you do next and keep going. And you just don't want things to spiral. Instead, you want to create that compounding so that you get the positive spiral on the other side.
And stay in it. And just because something might happen, whether it's the COVID and the markets, don't panic if you're off track or the market drops. Don't withdraw.
Absolutely, yeah. And I think that one of the important habits that you need to be building is to build your knowledge around investing in particular, because there's so much noise out there in the media and the headlines. And as soon as anything happens, it's like all of the headlines, there's a recession, and then it's, this is going to happen and that's going to happen. And meanwhile, you look at your investment account and it's gone down by 43 cents. It's like, you start to connect those dots that they make it seem like such a big thing, but you've got to think about the long-term impact and the actual translation to your bottom line. And reality is that time de-risks almost all risks. And so if you're in your 20s, 30s or 40s, you still got a long time to go. And so trying to think that you can time the market or that you can make a smart decision and you dip this way and then you'll dip that other way, you're probably going to get it wrong unless you get really, really lucky. And that is not a great strategy moving forward. So understand, particularly in the early days, and if you're new to investing, minimum standard monthly that you're doing one thing to level up your knowledge. Once you've built that solid level of understanding around what you're currently doing with your money, then you only need to keep leveling up your education when you're focused on something new. If you focus on, say, buying a property and you want to understand the ins and outs of that, or you want to look at a different sort of super strategy or whatever those things are, but then you can be targeted. But at the start, minimum standard once a month that you're consuming a video, that you're listening to a podcast, that you're reading an article or something, so that you've got more confidence in what you're doing.
I think one of the biggest questions, or when I meet people and we talk about something like Raiz, they say, "Oh, that sounds great, small amounts over time consistently." And I say, "Yeah, you should try it." They go, "Oh, it's not for me." The question is, but why? What we believe in at Raiz is financial education, financial literacy, inclusion, small amounts over time add up. How do we get people to start planning for the future?
One of the biggest things is getting people motivated enough to take action, because a lot of people get stuck in this inaction trap when it comes to their money. And look, I get it. There's so much noise that's out there in the world that it's like you want to do something, but you're not sure what to do. You start doing some research and it's sort of like you're drinking from the fire hose. Hard to know who to listen to, hard to know who to trust. Overarching with all of that is that you don't want to make a mistake. A lot of people in that case, they get stuck, and often they're not stuck doing nothing. Often they're just stuck doing the same stuff that they've been doing in the past. What that really means is that they're missing the opportunity to be getting better results and getting more out of what they've got right now. And so if you can look at the numbers, and I'm a numbers guy, I love a good spreadsheet to see that, if I do this, then these are the potential outcomes that are there. And when you invest, the biggest benefit that you get from any investment is in the last year that you own it, always. And so what that means, the flip side of that is that if you can just start a year sooner, then you're going to get that extra result, but people don't actually realize that. And so it's generally a pretty powerful thing to do for anyone that's listening along, and just jump over. I like the Money Smart compound interest calculator. It's on the government website, super easy to use. You put in, if I was to save $5 a day over 40 years, how would that grow? And what happens if I only do over 39 years? How much difference does that make? And it will, I guarantee you, it'll make a much, much bigger difference than what you think. And that's the opportunity. It's also the opportunity cost. And so I think that if people were clearer on the numbers of the impact of the actions that they're taking or not taking today, then that would spur them to take a bit of action.
Start planning, whether it's $1 a day, $1 a week, $1 a month. Start today. How do we get more people to either dip their toe in it or give it a go? Is it planning? Is it education?
I think the first thing is that realize that you don't need that big lump sum of money to get started. And I think that's the great thing about investing apps like Raiz, that historically people thought that you need thousands of dollars to invest, but you guys are breaking it down so that now you only need literally $5 to get started. And I think what a lot of people don't realize is that there's actually a huge difference between investing $5 a week and $0 a week, because even if you're investing $5 a week, which is something that I think everyone should have the ability to do, and I say that knowing that we're in like a cost of living crisis at the moment, but $5 a week, I don't care what's going on, you can make that work. And if you do that, immediately you're an investor now. You're doing better than 1 in 2 Australians, because 1 in 2 Aussies do not invest. And I guarantee you that if you start investing $5 a week, within 6 months, you're going to be investing more than $5 a week. And that's how compounding kicks in, that you go, okay, oh, I actually just got an increase in my hourly rate at work. Maybe I can put that up to $6, to $10, to $20. Oh, I got a pay rise. Now I can do a little bit more. And then you get that compounding effect. And you're learning things to make it less scary. I think a lot of people, when they're thinking about investing, they're thinking, oh, is Raiz safe? Are these other apps safe? Are the platforms safe? You work hard for your money. So of course you don't want to go and put money somewhere where it's going to disappear. But they don't realize how extensive the regulation is and how important it is to the government to make sure that investors are protected. They also, and I think it's probably partly the crypto stuff that people get a bit confused, because crypto is spoken about as this unregulated thing, and it is unregulated because the regulation can't keep up with how quickly the innovation is happening in the cryptocurrency markets. But it's a very, very different proposition investing in cryptocurrencies than it is investing into shares, ETFs, micro investing, managed funds, than it is in Australia. So people wonder, what if that something happens with Raiz? Is my money going to be safe? Or what if something happens with one of these other platforms? Is the money still going to be safe? But they don't realize that that's actually almost like a non-question because of how much regulation sits around that.
Look, I think that's a good question. And any listeners out there thinking about Raiz, we do have our bank level security. Your $5, every $5 is so important to us. It's something that we look at and check out every day. But going back to our planning, and I know this isn't financial advice, and we're just having a chat. But what would be the typical journey that maybe a 25-year-old second or third job, where would they go to get to these goals or start planning?
Investing is how you're going to get wealthy over time. And so if you want to get wealthy, you need to be investing. There's only a limited number of investments that are out there. You can invest into shares or managed funds or ETFs or micro. I put them all in the same bucket. That's like the equities bucket, to use a little bit of jargon. You can buy property, you can invest through your super, or you can pay down debt and save money in cash. So the last two, they're not like wealth building ones, but they are important things to do. So if you think about the options, well, you got super. Now your super, I think super is great. It's really tax effective and all those sorts of things. But if you're right at the start of your journey, super is probably not where you're throwing all of your money, because you want to get into the property market and you've got personal goals and you can't access your super until you're old. Similarly, property, or similar in some ways, that property is great, really effective way to get ahead, but also you're not going to go buy a property as your first investment unless you're you've got a massive trust fund or, windfall or something like that. Yeah. And so you're probably looking at the share type investing bucket, whether it's through a micro investing app or any of the investing apps that are out there. You want to invest into something. And look, the reason that I love investing apps is because it is so easy to get started with a small amount of money, easier than setting up like a managed fund account or having to go buy some ETFs and stuff yourself on a stock exchange. Can be a lot simpler. And so that's something that I think is worth looking at to build up that initial momentum. But to go back to your question, in terms of the pathway, it's like when you get started, shares is probably, and this is not financial advice, but it's probably the thing that makes the most sense so that you're getting growth most of the time. You look to build up some wealth, some investments that way. I also love property, and I think property tends to be a winning strategy because when you buy a property, you borrow money, you combine the bank's money, borrowed money, with your own money, and then you end up with an investment that's much bigger than you could get with your savings alone. And so it's generally a common journey is buy shares, crank up your share portfolio until you've got a reasonable chunk of money together. Then you buy a property. That's probably going to consume a bit of your savings capacity for a while, probably a chunk of the savings that you've saved up as well. You want to create a bit of breathing room for yourself, and then crank back into shares again until your property equity grows. You pay down a bit of debt, you build up your rental income, you build up your own income, and then maybe go buy a property again. But at that point, it depends really on your planning. And I think that's the crucial part. Like in the early stages, it's pretty clear. Once things evolve a little bit more, then it does get quite dependent on your own situation, the goals and targets that you've set, but also your personal things that you want to be doing, starting a family, starting a business, changing jobs or careers. These are all really great things for people to be doing, but they are also things that have a big financial impact. So really understanding what that financial impact is, and then assessing what you're doing with your money in a way that fits in with that, understanding that along with the numbers, because you already know how everything feels. Like buying your own home feels good, taking a year off work to spend with your kids feels good. Combining that with the numbers to just go, well, the emotions are not the only important thing. The numbers are not the only important thing. It's a combination of those two that's going to lead to the best decisions for you and then ultimately the best results for you.
You got to plan. You got to think about it. You got to visualize. But it's for you. Don't think about what your mate's strategies are. Focus on yourself. Be true to yourself and your understanding of where you need, knowing that you should start. You should start today. And I think the big boys say the best time to start investing was yesterday. The second best time is today. Plan. Educate, think.
And look at the numbers.
Right. What we're going to do, mate, is have a quick chat about you and sort of how you got there with Pivot Wealth and how it all happened, mate.
Well, mate, if it's all right with you, I might just flip the script and throw it back to you, because I know that you like to sit on the sort of behind the scenes side of things, but I'd love to hear about how your journey as an investor and how you ended up where you are now.
Where do we start? Look, I grew up in Newcastle, and I was very fortunate that my dad had some sort of experience in finance, and he thought it was important to teach us. I've got an older sister and a younger brother, Jordan and Cameron, to give us some sort of education and financial understanding. So I sort of had that understanding from a beginning. But then for all my sins, I haven't told many people that I did a commerce degree and was a trainee accountant. I remember the day Dad said to me, he said, let's pull out the yellow pages, and we wrote a few letters off. And I was fortunate enough to get an interview to be a trainee accountant at the same time, do part-time university. So, and I remember the day we wrote the letter, and they were on these blue sheets of paper for some reason. And Dad said to me, why don't you become an accountant? I said, I hate maths. I hate algebra. I hate all that. Why would I want to do that? Thinking that's what maths was what an accountant did, and it's completely different. And we've had conversations in the past, Ben, about making sure that financial education should start from the ground up in the schools and things. And that was my level of understanding of financial education, was that an accountant did algebra. Oh, I'm sure the accountants out there today will say they do algebra, but it is different, dollars and cents, etc. I was fortunate enough to get into university, do that. And away I went. Then I moved over to the UK and spent some time over there with the Royal Bank of Scotland in the finance team doing daily P&Ls for the equity trading guys. So that sort of got me the interest more in the equities market. And anyway, I moved through. I moved out to Hong Kong and Singapore and Tokyo with RBS, and then down to Sydney and then back to Singapore. For a change in lifestyle, I left the bank and opened up a bar with a friend. And we had a bar in Newcastle where I'm from. So we opened a bar in Sydney down here at Circular Quay, and things were going really well. I realized that I'm more interested in the financial education, financial awareness, and the finance world. Finance industry is probably the best way to put it. And at the same time, a mate from Newcastle rang me and said, hey, my grandmother's just passed away. She's left me some money. What shares should I buy? And I said, what do you mean, what share should I buy? He goes, well, is it a BHP? Is it a Telstra? Is it a CBA? He said, no, stop. There's this thing called diversification and all the financial jargon that you and I talk about all the time. And I was like, no, stop, hang on a sec. And at the same time, the opportunity to bring Acorns out from the US. And I was approached to say, hey, can you help set this up? Fast forward to today, we've now Australia's leading micro investing app. And for anyone that doesn't know what micro investing is, it's you invest for as little as $5. And what we do is fractionalize your portfolios, and all of those portfolios are well diversified. Again, this isn't financial advice. If you need financial advice, seek independent advice, etc. But that's what really attracted me to Raiz. Back in the day, was that it's all about financial education, financial literacy, and we break down the barriers to investing. So for as little as $5, we break down that mythical barrier of you need 10,000, 5,000, 2,000 to invest. It broke down, it sort of democratized investing for everybody.
And how much invested so far? Because you left that way.
Yeah, about 1.4 billion. So we have on the Raiz platform, we have over 310,000 active customers and over $1.4 billion in funds under management. What we do with Raiz is we break down the barriers so there's something for everything, and setting a plan, setting a target, setting some ideas, or just pausing and saying, well, I do have financial stress in my life. Let's write it down. Like, my wife laughs because there's Post-it notes all over the house because that's how I deal with things. That's how I motivate myself to do things. By seeing it written down, I will action it. So write down a plan, get into it, understand your risk profile, and say, well, how can I move ahead? How can I think about my future self? And write down a plan and start today. One of the things that a lot of people say to me is when crypto first started was, oh, you'd be in that, you'd be all over that. And I'm like, hang on a sec. No, because I do not understand it. I won't invest in something that I don't understand. And, we had a bit of a laugh before. My first ever investment in the equity market was Foster's, and it was a terrible investment. I thought with my heart, not my head.
At least you didn't do what I did and invest in Centro Property Group in the middle of the GFC. That was my first investment.
But again, on both of those little stories, it's you get up and you go again. You don't get down. You don't get defeated. You stop, you plan, you write it down, and you think about where you want to go.
And learn the lessons. Everyone's going to make mistakes. That's just par for the course. But hopefully, you don't make too big of mistakes at the start. You learn from them and then just build on it and improve from there.
Yeah, exactly. And so I didn't know what crypto was. I started learning about crypto. And what we did at Raiz was build a Sapphire portfolio that has a 5% allocation to Bitcoin. So for the people that want to get in and understand crypto and see it, get a hands-on experience in the app, they can come into the Sapphire portfolio. Something you and I both love is property. What we did at Raiz was create our Raiz property portfolios, and we currently have 12 residential properties around Australia in there, so that people can get in and understand how the property market works. You're having hands-on experience, and so there is something for everybody in that in the Raiz platform.
Love it.
Yeah, it's supposed to be all about Ben Nash, and Ben Nash does have a new book coming out. Just give us a quick plug on that, Ben.
So Virgin Millionaire tagline is your step-by-step guide to your first million and beyond. But the Virgin Millionaire is all about helping people to achieve a serious level of wealth, but people that are trying to do it on their own. So without a massive trust fund or a big leg up from family. A lot of people we work with that they're trying to achieve a pretty substantial level of wealth. And it's not just to have money for money's sake, but it's just because realistically living well in Australia requires you to have a fair bit of cash behind you. And so these people are often trying to achieve a level that exceeds the other people in their family or the people around them. And so it's all about helping you understand the practical things that you should be thinking about, the things to do to put the foundations in place and take it all the way up to the point where you've got full financial freedom and security.
Hits it right on the nail of the head. So have a read of Ben's book. Start planning, start thinking about, and think about the practicalities. And at the end of the day, be honest with yourself. Be honest with yourself with your level of availability to invest, the level of your own financial education, and there's resources out there.
100%.
Thanks, Ben. Thanks for being here.
Good to be here.
Thanks for listening to this episode of Raise Your Game. Any advice is general advice only and does not take into account your financial situation, objectives, or needs. The Raiz Invest Australia Fund is issued in Australia by Industry Investment Limited, ACN 128813016 AFSL 434776, a subsidiary of Raiz Invest Limited and promoted by Raiz Invest Australia Limited, ACN 604402815, authorised representative of AFSL 434776. PDS and TDM are available on the Raiz Invest website, www.raizinvest.com.au. You should read and consider those documents before deciding whether or not to acquire interest in the product.